Hello and welcome to the show. 1 month and 12 days to the next Fed decision, which will be a big one according to many people who are watching it, and 6 days and counting to the U.S. election. So question is, are you and your portfolio ready for either a Clinton or Trump administration? My guest tonight says some stocks which have been already discounted ahead of the election are looking very attractive. David Pearl is the co-chief investment officer of Epic Investment Partners. He joins me from New York. David, great to see you as always. Let me just jump right in here. We'll get into the fundamentals, I promise, because I know that's more your wheelhouse. But I have to ask, we're getting so close to the election, day by day, we're watching the peso. It jumps up and down based on what's happening with, Mr. Trump's seeming popularity. What are you telling clients, or what are your thoughts around this election in terms of what it means for markets?
Right. Well, certainly there's going to be volatility. This is now turning out to be an extremely close election. There is a distinct possibility that one of the two candidates could win the popular vote but lose the election based on the United States Electoral College system. So there's a real possibility that the decision will not be done on November 8th, that this could be litigated kind of the way we had with Bush and Gore a number of years ago. So uncertainty will remain for a while. The positive, though, is that it does seem that Congress will remain divided, and I say that positive in that there will not likely be drastic change from either side. We'll have the usual kind of gridlock that we've had over the last 8 years to a great degree, and so anything that has to be done will have to be a negotiation between the two parties.
Which means gridlock, to your point. So actually, it's funny, you just said litigation, and it just made my stomach turn thinking about, how long that would take to get the final election results. Let me ask you, though, when it's all said and done, when we actually have, or you have, I should say, a new president and they're in office, what would you say from an investment perspective is the difference between a President Trump and a President Clinton?
Yeah, from a policy point of view, Clinton would be a bigger negative for large banks in the United States. It's a continuation of President Obama's policies, higher regulation. She certainly would be tougher on health care, particularly pricing of health care from this point on. And lastly, fossil fuel. Trump, it's a little harder to pin down. He's anti-trade for sure, which we think Clinton would not be as tough as some of her rhetoric on trade, but Trump would be. And in every other way, he would be a little more pro-business, but it would be a little harder to say which industries benefit or are harmed more by a Trump administration. But again, it would not be sweeping change unless Congress goes completely to one party.
David, let me ask this question, and this is a hard one. I find with most people that I speak with, I'll hear things that you mentioned, again, split Congress, and we're going to get it's still, I think people are still betting you're going to have a Clinton presidency, although it is getting very tight. What about unrest? And again, I know this is not an investment-specific question, but it speaks to, I'd say, consumer psychology and how people are feeling, the confidence in their country. If there is some sort of unrest that comes out of that, how does that affect your thoughts from an investment thesis?
Yeah, then you get back to fundamentals, but really the economy. So the U.S. economy is in a sustainable recovery. It would take a giant shock to, basically lower consumer confidence, consumer spending, which in turn would then cause a recession. So I still think that would be an unlikely scenario. There will be volatility. There will be discord for a while. But if we go back to Bush, Gore, it eventually gets settled. The country is a country of law, even though there'll be a lot of litigation, perhaps, if that's the case. But we will wind up with, a president. People have gone through a number of scenarios about, whether at some point Congress would have to appoint a president, whether President Obama would need to pardon one of the candidates. There's just so many things that could possibly happen right now. It's unprecedented. So no question there's uncertainty, but if you look at the stock market, it took a dip down last Friday when the last email news on Clinton came out. It's been, down, but not very much since. It's stabilizing. And as I say, if you look at the individual stocks and industry groups, you could see that the the consensus view is that not a great deal will change. And there really are opportunities in equities in the United States, given that the economy is growing, consumers are spending, corporations are willing to spend money as well. And in the environment where interest rates might continue to go up a little bit, there are winners and losers.
Let me get then into more specific stuff then, because I know that you've been taking a close look at the healthcare sector, financial sector, because of, again, some of this discounting that has come in based on some of the scenarios, the many scenarios you said that could come out. Tell me what's interesting for you in the healthcare sector right now.
Yeah, so healthcare is the second cheapest sector in the market. The U.S. stock market is trading at about 18 times earnings. The healthcare sector is in the low double digits, like 13, 14. And the stock we really like is AbbVie. It's one of the major pharma companies, although not probably the most famous. They happen to have the biggest drug in the world right now, which is Humira for rheumatoid arthritis. And the stock is selling at less than 11 times earnings, has a almost 4.5% dividend, and it's going to be growing in the high single digits. And this is with drug pricing being muted. In other words, they're taking low single-digit price increases in the forecast I'm giving you. So they can grow earnings faster than most companies in the market, and they're way, way cheaper with a huge dividend. So very attractive stock. And again, unless, in this case, Democrats controlled both houses of Congress and the presidency, under current law, you cannot regulate drug pricing from the government's end.
Let me ask you before we go to break then, the financials, I know another sector you think that have been perhaps overly discounted going into where we are right now. So what's interesting and attractive there?
So financial services is the absolute cheapest sector of the stock market. And we are afraid that the large banks in the U.S. are under too much regulatory pressure, and that may continue under a Clinton presidency and even under a Trump presidency. So we prefer the regional banks. One we like is BB&T, which is in the mid-Atlantic, from New York down to the south and almost into the Midwest actually. And it's trading just a little over its book value, about 12 to 13 times earnings with a 3% dividend. It grows because as the economy grows, consumers take out more loans. If interest rates go up, which it looks like they're going to do eventually here, they benefit as well. So the combination of consumer spending, interest rates, and lighter government regulation on their size of a bank, it's very, very attractive at a very low valuation.
All right. Thanks, David. Stay with us. When we come back, we're going to have more with Dave.
Sure.
We're going to be talking a bit about the tech sector, the overall U.S. economy, the Fed. It's all coming up. You're watching Money Talk. We'll be right back. Welcome back. We're here with David Pearl. He is the co-chief investment officer at Epic Investment Partners. I have to restrain myself, David, because I actually want to talk to you about all the different scenarios you talked about that could happen, because that's actually quite fascinating, but I'm not going to do it. I'm going to keep it to an investment conversation because I promised myself. I want to talk a bit about the economy and just the strength of the U.S. economy. You said, providing there's not a huge shock, things are actually looking pretty good right now. We've got a chart here showing the employment growth in the U.S. right now. So let's bring that up and take a look and tell me why you think that paints a positive picture for the states.
Okay. So the point being is that we have been gaining an average of nearly 200,000 jobs a month for a number of years now. We are near, the low end of typical unemployment. That said, we have large structural unemployment in the U.S., but that is something that we will have to deal with probably over a long period of time, even a generation. That said, when you get employment down to 5% or less, which we are, you start having wage increases. Wage increases are really good when you're at low inflation. It is beginning to cause some inflation, which is actually good for the economy and good for business. And of course, people's confidence feel better. They feel better about spending when they have wage increases. So consumer confidence is up as well. Consumer spending, by the way, is up about 4% year over year. That's really robust considering GDP is up on the 2% range, although this quarter is up almost 3%. So the U.S. is one of the strongest economies in the world, driven by consumers. It's 70% consumer spending. And that job picture looks good. And, you know, if you think you can get a better job for more money, you're certainly willing to buy more things. So there are stocks that are going to do very well from consumer spending point of view.
We've got up a picture here just to illustrate what you were talking about. I think we're taking a look here at real disposable income growth, which is a 2.7% growth, and also small business. I believe this is hiring and compensation increases. Again, you think this also paints a positive picture?
Yeah. Yes, it's actually very positive because for corporate profits, they like a small amount of inflation, which lets them pass through price increases. Consumers, of course, feel wealthier if their wages go up. So it's a virtuous cycle. Of course, you don't want inflation out of control, but you want some positive inflation. It's one of the factors that the Fed is very keen on before they raise rates. They effectively have a target of 2% annualized inflation that they would like before they start really raising rates. And there is a value to raising rates because we have been abnormally low in interest rates for now 5 years. It has stopped having a positive effect. You'd like to normalize rates and have a normal yield curve, which is healthy for the economy, very good for banks and financials. So, you know, this is all looking like we're going in the right direction.
David, what are you going to listen for? Because I think, again, you and I think most people believe that we're going to see something on December, I think 13th or 14th, when they come out with their next rate decision. But I know some folks I spoke to, you know, the key is going to be here, the rate of pace, or sorry, the pace at which they'll be increasing rates after the December decision. So what do you think we're going to hear on that front?
Yeah, I must say, you know, the U.S. economy is the best in the world, and that is a low bar. This is probably the worst recovery since World War II in the United States. So it is not like we are rip-roaring here. Because of that, we don't think rates are going back to where they were even pre-financial crisis. So, you know, when we talk about a more normalized rate environment, the short end could probably go to 1%. So if the Fed raises 25 basis points in December, that would be 2 more raises next year. And maybe the long end goes from, you know, we're 180-ish to 2, 2.25, you know, at most 2.5. So not a huge change. It wouldn't be the end of the dividend investing cycle for many retail investors. In other words, equity dividends are still very attractive relative to fixed income dividends, particularly in the United States, where, you know, the S&P 500 dividend yield is about 2.5%, but only 1.8 for treasuries, 10-year treasuries. So still, dividend investing is going to be good in equities, but also with a growing economy, growth stocks and value stocks can do better because there have been a lot of groups that have had multiple compression, particularly economically sensitive ones, consumers, discretionary, technology, as well as financials and healthcare in this case, special case, versus the defensive stocks that paid big dividends and have done well over the last few years. So there could be a reversion of the mean for these more economically cyclical stocks when the economy is doing well. So we do think, again, stock picking opportunities. We talked about financials, talked about healthcare, but also industrials and technology benefit quite a bit by a better economy.
I've got about a minute, David, and I do want to touch on at least one tech stock that you like right now. Microsoft, if I'm not mistaken, had a pretty boffo set of earnings recently too. But what's your thesis behind this one?
So this is really the big picture, is that technology really is a macro. It's changing the world. It increases productivity and lowers cost. And the biggest one is the cloud, the movement of computing out of your desk, out of your office, into the cloud. It saves a whole lot of money. You don't need a lot of IT staff, much more efficient, much better run, because, you know, if Microsoft runs your cloud, there's one call to make and it always is updated with the latest software. So Microsoft has become the second biggest cloud company after Amazon. And, you know, if you like Amazon, Microsoft is 1/5 the valuation and actually is growing a little bit faster in the cloud. So you know, it's a new Microsoft than it was a number of years ago. You don't even need Windows to be important anymore. It is the growth of the cloud.
Fantastic conversation, David, as always. So appreciate your insight, and we'll talk to you soon. Look forward to talking to you after your next election.
Definitely. Thanks.
All right, take care. David Pearl, he's the co-chief investment officer at Epic Investment Partners.